Hey, it's Cashflow Mike, and today I'm going to be talking about Small Business 101. It's what every business owner needs to know, right? So I've worked with thousands. I've trained bankers, I've trained accountants, bookkeepers, advisors, fractional CFOs, and there's always a basic mistake that people make when you start your business. So why is financial literacy a secret weapon of small business, right? You might be good at dry cleaning or making pastries or repairing cars, whatever it is your small business is going to be. You might be good at that. But here's the truth. Most small business owners didn't get into this because they were dying to run the numbers, right? You didn't set up and start a business just because you had a skill or a product or an idea. But that's where most folks hit a wall. They're good at what they're doing, but they don't understand the numbers, and you'll never really feel fully in control of your business if you don't. So financial literacy isn't just for CPAs. It's not for MBAs. It's a secret weapon that separates struggling businesses from thriving ones. And with this amount of time, this little video, we're actually going to start the moment. This could be your moment that you start using financials as the weapon for your success and with precision, right? You're going to use financials with precision. So in this video, I'm going to walk you through the most searched topics, right? There are most searched topics that are about small business financials on YouTube, right? So people come to YouTube, maybe like you did, and search these things. Why? Because when people search these things, it usually means they're stuck. They're looking for help and they're ready to make smarter decisions. So we're going to cover things like profit versus cash flow and why they're not the same thing. We're going to learn how to read financial statements without your eyes glazing over, right? We're going to learn about what EBITDA is and why it's worth knowing, even if you never ever say the word or you never ask for it in your life. Yeah, I'll tell you why it's worth knowing. We're going to also talk about how to calculate gross margin or gross profit margin and how to use it and price your goods smarter. I'm going to tell you this about gross profit margin right up front. It is the most important number on your income statement. It is the only place in your business for you to get cash to spend on your expenses or put in your pocket. So remember that. Gross profit margin is the most important number on your income statement. We're also going to look at some smart small business budgeting basics, forecasting revenue expenses, and the part that most people skip and regret, right? So we're going to think about that, how to forecast and not skip the most important part. Then I'm going to finish up with some common financial mistakes and how to fix them before they sink you, right? So that's kind of what we're doing. I'm on your level. I'm talking to you. So let's get started. Let's go grab some coffee, grab your notes. This is Small Business Financials with Cashflow Mike. First subject we're going to talk about is profit versus cash flow, right? So just go search the term. Why am I profitable but have no cash? It's common. It's the most common one that's on YouTube right now. This one hits home for almost every business owner that I talk to because you open up your financials and you see that you made $50,000 in profit last quarter, but your bank account looks like it skipped town, right? Here's why. Because profit is what you earn, cash flow is what you have. Think of profit like a paper promise. It's what your income statement says you made, but it doesn't factor in the timing when cash actually hits the bank account. It's just, I sold this much, I spent this much, this is what should be left over. But guess what? It doesn't account for money that goes into the bank, the deposits. So you might have sold a job for about $10,000 last month, but if you don't get paid for 45 days, that's not cash in your head, and you know it, right? You might have bought a truck. You might have paid insurance, restocked your inventory. All of that goes out before the customer even paid you. So here's the solution. Start using a cash flow statement. This is going to tell you the real story. I call the cash flow statement the tattletale of the business, right? But when you're looking at the cash flow statement, it's going to help you budget. Build a cash budget, not just a forecast. Sometimes when people forecast, it's just about the income statement. But I want you to build a cash budget and forecast the way cash comes in and the cash moves out week by week. Look at it on a weekly basis. So learn how long it's going to take you to turn a sale into actual money in the bank. That's called your cash conversion cycle. So when I give someone an invoice, how long does it usually take for somebody to pay me? That's how you're going to start planning out. I get an invoice today. I might not get the money for another month or two. So you're not broke. You're just out of sync, right? That's what this is. You have to fix the timing and then you can fix the panic, right? So fix the timing, then you can fix the panic. So number two, the thing I was going to talk about today was, let's talk about how to read financial statements, right? So search this term. How to read financial statements for beginners, right? And let me make it simple. There are 3 financial statements that every business owner needs to check regularly, like brushing your teeth. It keeps things from rotting, right? The income statement, a couple of things. It's going to show your sales, your expenses, and profit over time. The income statement is the one we always lean on. It's like the report card, right? How much did I sell? How much did I spend? But I'm going to tell you something about the income statement. It only is going to tell you if you had a good month or quarter or year, and then it starts over. Most people don't know how it starts over. Well, it starts over because at the end of the month or quarter or year, profit gets subtracted to make it 0. So it gets to revert back to 0 at the top and start over. And their profit gets subtracted there and added on the balance sheet in the form of retained earnings. It's way down at the bottom in the equity section. So retained earnings, profit becomes retained earnings. Just remember that. That's where those two connect, the income statement and the balance sheet. Now, the balance sheet, most people will look at it and go, I don't get it, right? They know that assets is supposed to equal liabilities and equity. Maybe you don't, but the number at the top with your assets is supposed to equal the 2 things that are added together on the bottom. That's what makes it balance. And most people will look at it and go, those numbers are supposed to match. Bookkeeper's doing a good job. But here's what they don't tell you. It's also going to show you everything you owe, everything you own, everybody that's giving you money. So think about this. Assets is the stuff you have and the stuff you bought. Liabilities is money you borrowed to do what? To buy that stuff. Equity is money that you or your friends or shareholders or stockholders, whatever you're calling them, put into the company to do what? To buy that stuff. So think about it like that. Here's the stuff I bought. Here's where the money came from to buy the stuff. I either borrowed it or I put it in myself. That's how you read a balance sheet. A balance sheet, unlike the profit and loss statement that's going to tell you if you had a good or bad month or year or quarter, a balance sheet for anybody that can read it is going to tell you if you have a good or bad company because it never starts over. It keeps going on and on. It is the living history of the company. It has is the culmination of every single decision you've ever made in the balance sheet. The last one, the one that nobody looks at, the one that I'm named after, right? Cash flow Mike. It's the cash flow statement. And I'm going to tell you a secret. It is the tattletale of the business. Anybody that knows how to read a cash flow statement knows where the money came from and what you did with it. It doesn't matter what story you tell somebody. All they got to do is look at the cash flow statement and says, oh, you made it from your business. It came in from sales and you made a profit. And then you bought a truck. You bought fixed assets. Anybody that knows how to read cash flow statement knows what you did with your money. You're not going to fool anybody. That's why they ask for it, right? It's like a point of verification. So now here's what most people do. Most folks do. They're going to look at one, and it's usually the P&L, and they call it good. But these statements tell different parts of the story. It's like watching one scene of a movie and thinking, oh, I get it. I got the plot. So just ask yourself these type of things, little things like, is my revenue trending up or is it flat or is it going down? Are my expenses eating up all my profits? Am I building equity, right? Or am I draining it? Am I keeping money in the company or am I taking it out, right? Everything I get, I use to finance my lifestyle. I buy boats. I buy a bigger house. I go on trips. That's draining the money out of your company, right? Is cash flowing freely or getting stuck? So think about I give somebody an invoice and I'm waiting for it to pay. What are the processes I'm doing it? And are there choke points? Like maybe I'm using snail mail instead of email to get an invoice out, those type of things. Look at the way your money moves. And if there's a choke point, focus there to free it up. You want money to move fast. It is the speed of cash. Think about that, moving fast. All right. And don't worry. I'll tell you what, don't worry about being a CPA. Worry about asking better questions, right? The numbers are going to give you the answer. So next one, number 3, I told you we're going to talk about EBITDA. And no, it's not a foreign word. EBITDA means earnings or profit before you add back in taxes, interest, depreciation, amortization, right? EBITDA. So why is it important? Because EBITDA to me, it sounds like something you catch from eating bad seafood, right? Right? So, oh my God, I got the EBITDA again. No, EBITDA is a financial calculation used to put you on the same playing field, right? It's like true cash that's flowing through the business. Bankers use it as a substitute word for cash flow. It's true cash moving through. And when I said it's used to compare you to other companies, it's because we all make different decisions. The reason why we add back in something like interest is because You might start your company and do it with a loan. You're paying interest on the loan. I might start my company, well, with equity. I take money out of my bank account and put it in there. I don't have a loan, so I don't have interest. When we add back in your interest, you and I look the same, right? Interest doesn't matter. Taxes are put in because they're just a result. You only pay on the, whatever's left over after your tax strategy. So they're just a result. They're not an operational expense. So it's only done after the fact. So taxes are added back in. So no matter what you do on your taxes and I do on my taxes, we look the same. Depreciation and amortization. This is spreading out the expense of something you bought, right? You bought a truck, or you bought a patent, a trademark, those type of things. And you spread out the cost over the course of time that asset is supposed to be generating revenue for you. If I buy a truck, it's because I want to go sell my services using the truck. Well, the government would tell you in the useful life chart how long you can spread out the cost of that truck, right? Because there's a principle of matching, meaning the expense of something should match the revenue that's coming in, right? The expense and the revenue should match. I use this expense to create that revenue. Well, here's the other thing about EBITDA, right? EBITDA is also going to, or depreciation and amortization. Depreciation and amortization is also non-cash. No money leaves the building. Nobody ever writes a check for depreciation and amortization, so they're going to add it back in because, again, this is about cash flow and true cash flow. The other thing about depreciation and amortization is that we're going to use different methods, most likely. You might use a method called straight line, where I just divide it out over the number of years. And some other people might use a depreciation method called double declining balance, where I take more depreciation in year 1 and less in year 5. Well, EBITDA makes all that go away because it makes us look the same. If I add it back in, whatever method you used is the same as the method I use because it doesn't matter. It's part of cash flow. All right, so it's really kind of a useful tool though. In plain terms, it's your operating profit. Before all the fancy accounting stuff I just talked about, it's just used to measure a business's true earning power. It's going to strip out financing decisions and tax strategies to get to the core. How well does this business perform at what it actually does? That's what it's looking at. How well do we perform at what we do? So if your EBITDA is strong, your business is valuable, even if the bottom line doesn't show you yet. Another little trick about EBITDA, EBITDA is used to calculate how much you can afford from the bank, right? So when they go to give you a loan, they're going to look at your EBITDA, and usually, this is a rule of thumb. This isn't true of every bank, but it's going to get you in the ballpark. About 3 times EBITDA is going to be about the max they're going to lend you. So you won't be embarrassed when you go in. You'll be able to see, about how much you can afford before you walk in the door. So the fourth thing I want to talk about today is gross margin basics, right? Gross profit margin. And so I want you to search this term, right? Which is how to calculate up gross profit or gross margin. Gross margin is going to tell you how much money you keep after you pay for the thing that you sold. So if I buy a big box of t-shirts at $5 a piece and I sell them for $10 a piece, the difference, I got $10 from the customer and I paid the vendor $5. That $5 is gross profit margin. So here's the formula. It's your revenue minus the cost of goods sold. That equals gross profit. But then if you divide it again, the gross profit number by revenue, it's going to convert it into a percentage. You're like, oh, what? Mike, that's a lot of math for a video, right? So, but if you sell a widget for $100, we'll say, and it costs you $60 to make it or buy it, then your gross profit margin is 40%, right? $40, 40 is divided by 100 is 40%. So this tells you how much money is left over. Gross profit, remember, is the only place that you can get money to pay for your rent and your payroll and your operating expenses, your office, your subscriptions. All of these things come out of gross profit, not your sales. You can't spend sales. You have to spend sales to buy the inventory to keep sales going, or to pay the payroll if you're the service company to keep sales going. Only what's left over after that expense. So when someone says, hey, I just need to sell more, I ask them, sell more of what? If the margins are too low, more sales won't help, right? You're just going to lose money faster, right? Selling more at the lower price, losing money on every sale, you just lose more money faster. So your margin is like oxygen to your business, right? That's why they call it the lifeblood, this cash thing, it's what keeps you alive. Gross profit, gross profit, gross profit. And then number five, we want to talk about budgeting, right? So here's what you would search. You'd search how to create a budget for my business. So budgeting isn't about restrictions. Some people think it is. It's not about restrictions. It's about intentions. What are the things that I need to do to keep this business operating? So when you build a budget, you're telling your money where to go before it disappears. Quite simply, that's what you're doing. You're saying, Mr. Dollar, you're going to go to rent. And so budgeting, that's all you're doing. You're telling your money where it's going to go before it disappears, because without it, your business runs on hope. And we all know that I call hope hopium. So stop smoking hopium in your business and have a plan. Be intentional. And hope is not a financial strategy. So here's how you do it. You're going to create a forecast of your monthly income, right? Use real data. Don't just dream it up. Use real data. So go back in time and go, oh, over time, I normally get this much in January, this much in February, blah, 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 on and on and on. Then I want you to list every single fixed expense. And now fixed expense are things you have to pay even when you don't make a sale, like rent, like salaries, like, hourly wages, insurance, those type of things. So fixed expenses you have to pay even if you sell nothing. I don't pay for, the service hours of, in my hotel staffing company if I don't put them to work, right? They don't work, so I don't pay the hours. I don't pay for the shirt sitting on my shelf because I do pay for it because I have to pay the vendor, but it's not an expense in my income statement until I sell it. Then it becomes cost of goods sold. In any case, revenue always kind of underestimated, right? And expenses always kind of padded just a little bit because there's always things that pop up. You need this, you need that, you need a new camera, you need new cable. Doesn't matter. Give yourself a little bit of room. And don't forget profit. I always add two things into profit. One, what I should be making, whatever the industry average is. If everybody else makes 5%, I try to make at least 5%. But then the other number I add to it is, what is my transferable value number? What is the number I have to save for me, not my salary, but save out of the business for me every single month to fund whatever it is I want to do next? If I want to buy a truck, if I want to buy another company, if I want to retire, I should be stacking away a little bit of cash every month if I can to be able to afford my future, right? So you need to be thinking about your future every single month. And then I want you to do this. Just track what you're doing actually versus your guess, right? Your guess, what you put on there, that's your budget. So track your actual versus budget every month. And you're going to start to see patterns on where you missed, and you're going to be training yourself, right? So you're going to catch overspending early. Like, oh man, I went out to eat too many times, or I shouldn't have gave, these customer gifts at that budget level at $100 and it should be at $40 or whatever it is. You'll be able to catch overspending earlier and you'll make smart decisions. You got to look at, forecasting revenue, expenses, those type of things as crossing the street. I go, Mike, what do you mean crossing the street? Well, what do you do when you cross the street? You look both ways. That's what forecasting is. The reason why you look both ways is so that you don't get hit by a car or a bus or something like that. And the farther away you see the bus, the more options you have to avoid it, right? You can run, you can walk, you can TikTok in the middle of the street, doesn't matter. But if you don't see the bus, you may walk out in front of it. What forecasting on that doesn't do is tells you how to make the bus stop or bus turn. There are other techniques to be able to get you to avoid any disaster that's coming your way. So in revenue and expense forecasting, just search this. Search how to forecast revenue. And forecasting is going to be like checking the weather before a road trip, right? It doesn't guarantee sunshine, but at least you'll pack an umbrella if you think you're going to need it. So when you forecast your revenue, I want you to look at last year's numbers. If you don't have last year's number, kind of guess, but always be a little bit on the low side here. I want you to adjust for growth and seasonality or known changes like, oh, I think I'm going to get a new client in March. Or, I sell swimsuits. We probably won't sell that many in December. So always adjust for your seasonality because we never peanut butter sales straight across. Hardly anybody, if anybody, has the exact same sales every month, month after month. So adjust for what's real. Make it feel and look real based on what you know. Then I want you to factor in some other changes like new hires. Like I want to grow. I'm going to need another salesperson, another support person, or another plumber, whatever you are. Plan it for new hires. Plan it for any software that you need to add or other purchases you might need to make. right? And then plan for the unplanned. Like on what? Plan for the unplanned. Repairs. If you got equipment, you're going to have repairs. If you got a building, you're going to have repairs. If you've got things, you're going to have to repair. Plan for taxes and paying taxes. Don't forget, some companies have to shutter because they don't make their matching tax payments. They don't pay their income tax. They don't do their estimated tax payments. Make sure you're planning for tax inside this budget that you're putting together. And then delays. When you think you're going to get paid in 30 days, create another version that says, what happens if I get paid in 45 days or 60 days, right? So if I was doing it, maybe 3 different. I got a best case scenario, a worst case scenario, and then maybe a most likely, what I think is going to happen. And I'll work that most likely until the reality of the situation tends to put me in a different direction. So just start simple though. I mean, I've thrown a lot at you, but just start simple, but don't wait until your accountant sends you a surprise, right? The better you can predict, the more confident you're going to be. So let me go over some common mistakes and how to fix them, right? Just some common little things I see people do on a regular basis. And when you go to YouTube and you search for things, search for common small business finance mistakes, right? So here are the landmines that I see over and over and over again. People think that profit equals cash. It doesn't. Profit does not equal cash. People mix business and personal finances, right? They just look at one account, or I can make my personal purchases out of my business account and vice versa. No, keep them separate. I had a client that says, well, I said, why do you have so many banks? I said, Mike, you told me if my business and my personal accounts separate. Yeah, just separate accounts. You don't have to do business with 10 banks, right? Just have separate accounts, right? Business checking, business savings, personal checking, personal savings, credit cards. You can do it all with one bank. You don't just have different accounts for different things, right? So ignoring the balance sheet, it's too hard, so I don't want to look at it. Don't ignore the balance sheet. It tells a story about your business. I also see people not tracking receivables and collectibles. How long does it take to get paid, and how long does it take to make my payments? And then say yes to every sale without checking the margin. Am I going to make money on this sale? Make sure you know that before you start. And if you're in a service-based business, build in some buffer. You know there's going to be scope creep. You know there's going to be, warranty work, things that you have to go back and fix. Build yourself in a little bit of buffer to be able to handle that. So here's how you're going to fix these, right? So I want you to run these cash flow forecasts like we talked about. I want you to use separate accounts for your business. I want you to review your financials monthly. Get used to looking at them, looking for trends, seeing how things move, knowing what happened, because the sooner you look at them at the end of the month, you remember what happened. You just lived it. You just made those decisions. See how your decisions look on paper. Then I want you to follow up on your receivables weekly. When those things start getting there, and everybody that's past due, 30 days, whatever your net terms are, start calling them, right? I make some phone calls, get some money coming in. Don't let those sit out there and ignore them, because when you ignore them, so does the customer. And then I want you to focus on profitable sales, right? It's not volume. Sales doesn't really matter. More sales only means more work. It's what you make on the sale. That's where you want to focus, the gross profit. So I want to tell you this. If you've made these mistakes, you are not bad at money. You just haven't built the habits yet. Not bad at money, you just haven't built those habits. So let's talk about taking action. What's next? You just invested all this time with me, listen to me blow you about all these topics. But here's the deal. You don't need to become an accountant. You just need to become a business owner who understands how money moves in their business. So I'm going to start with one thing, and maybe it's reading my statements monthly, watching what happened in real life versus how it looks on paper. And then maybe I'm going to build a simple forecast. What do I think is going to happen next, right? Because accounting, that's like somebody that's the historian of the company. It already happened. There's nothing I can do about it. Forecasting is like being the GPS for your business. What's going to happen next? Predicting the future. Both things are important. So, and then maybe I'm gonna set up that budget, right? And remember, budgets aren't restrictions, it's intention. What am I gonna do with this money when it comes in? But whatever it is, I want you to make your numbers work for you, not the other way around. Make them work for you. Put them in different formats. Just because GAAP says you have to do it this way, if you don't understand it, you know it a different way and you can understand what you're talking about, convert it. have your accountant help you put it or just convert it to numbers that you make sense to you, because it's more important that you can make decisions based on what you're seeing than it is putting it in a format for GAAP accounting or the accountant, right? So you got this. I tell you, you got it. And if you want to go deeper, I want you to check out my program, the Clear Path to Cash. I teach all these techniques. I've got tools, I've got apps, I've got worksheets, I got spreadsheets, I got things for you. And I've done it. 14 businesses, 14 companies. I've been in your shoes. I've made all the mistakes. I can help you through them. So we're going to take all this and we're going to turn this into practical tools for you, right? That you can use, if you're an accountant with your clients or if you're an owner with your business. So I'm going to see you next time. So let's go out there and make some smart money moves, right? Make some smart money moves. I'm Cashflow Mike. We'll see you next time.
Taking action. Here's the deal. You don't need to become an accountant. You just need to become a business owner who understands how money moves. Start with one thing. Maybe it's reading your statements monthly. Maybe it's building a simple forecast. Maybe it's finally setting up a budget. Whatever it is, make your numbers work for you, not the other way around. You've got this. And if you want to go deeper, check out the Clear Path to Cash program. We take all this and turn it into practical tools that you can use with your clients or inside your business. See you next time. Let's go make some smart money moves.